In this video, I'm going to talk about our retirement paycheck system. I'm going to take the whole topic of generating consistent income in a tax-effective way from maybe confusion, a lack of clarity, so that by the end of this video, you are going to have a ton of clarity and have direction on what steps you should take to generate the income that you need for retirement. In addition to that question, people have been saving money for years. When they get in their 50s and 60s, they're going, okay, I've been putting money in my RRSP account. I've got money in TFSAs. I've got a little bit of money in non-registered accounts. If you're a business owner, you might have some money in your corporate account that might be used to supplement retirement. I've got a lira that I accumulated in a past life with an employer, and I have some pension income with maybe my current employer, and then I've got my government benefits. How do I take all those different buckets of income and assets to generate the income that I need? So we're going to talk about the different drawdown strategies, the most common drawdown strategies to use by taking a look at our SNAP projection software. We're going to finalize which of those strategies for our case study is going to work best, and then we're going to apply that particular scenario to our retirement paycheck system, and how we can begin going from the modeling of retirement to generating consistent income on a tax-effective basis. Welcome to the video. My name is Shaun Humphries. Our firm has been doing retirement income planning for 3 decades. And if you want to know more about retirement income planning in general, make sure you go to the show notes to download our free resource bundle. And if you are getting serious about retirement income planning, or the show notes as well, you can set up a complimentary meeting to learn more about our retirement income planning services. So in this presentation, I'm going to cover off 3 main topic areas. So first of all, we're going to look at a few different drawdown scenarios for our case study today, and then land on what we think is the best scenario to pursue. Number 2, we're going to apply the 3-bucket timeline strategy to the chosen scenario. So it's an investment allocation strategy to generate the paychecks on a regular basis. And then third, once we have our 3-bucket timeline, then we can begin talking about what investments would be appropriate for each of those timelines. So those are 3 critical areas we need to be clear on before we start generating those paychecks for retirement. Now, where generating a paycheck for retirement starts is with a retirement income plan. Financial planning or retirement planning is critical because it's going to begin giving us some clues about what the best strategy is for you. Now, it's important to keep in mind that retirement income planning and generating a paycheck is going to be a function of not just taxes, not just investments, but also what your personal goals and objectives are. For instance, your burn rate. How much money do you want to spend? Where's that money going to? There could be discussions around estate planning. So sometimes clients' drawdown rate or paychecks going to be influenced by legacy aspirations. For some clients, it's die with zero. For other clients, they want to not kill the goose that lays a golden egg. So there's a legacy value for their kids or their grandchildren or community. So you need to look at the paycheck strategy in the context of overall financial planning. Another way of looking at it is that retirement income planning is this ongoing conversation on the left-hand side of this chart, and then the implementation of an investment strategy to generate those paychecks on a regular basis. So the discussions are, like I said, how much after-tax income do you want? What is sustainable? What are the guardrails you need to be aware of? What are the overall planning objectives you're trying to achieve? And then that will influence your design of your portfolio, and we'll talk about portfolio design in just a few minutes as part of the timeline discussion. Now, key to the financial modeling is going to be using our SNAP projection software. I'm going to show you the back end of the software just in a few minutes. But the first thing is to begin looking at the overall balance sheet. So we've got Bob and Barb, and they have a financial portfolio right now of about $1.96 million. They have a margin account. Bob has a margin or a non-registered account of $400,000. Barb has a TFSA of $180,000. Bob's got the equivalent value. Bob has $900,000 in RSP capital. Barb has $300,000. They have real estate. So they have a cottage worth $500,000 and a residence worth $800,000. So they're coming to the table when they hired us to do the planning with about $3.2 million net worth position. Like I said, just under $2 million in financial assets. Now, some of the key assumptions we use in the model, we used an inflation rate of 2. We assume that government benefits, CPP and OAS would be indexed to 2. And we assume investments on cash are in 3, fixed income or income investments 3.9, and equity investments, the default was 6.54. And I'll show you the weighted average return on their portfolio based on the investment mix. Now, keep in mind, this is for modeling purposes. You might have different opinions about expected returns, but I'll show you what we used in terms of asset mix design and the weighted average return for their particular circumstances. Now, what I'm showing you here is just the investment mix that we're using. This is for Bob's situation. You can see that On the RSP account, we're using 20% cash position, could be GICs, high yield savings as an example, 20% fixed income, so government bonds, corporate debentures, other income vehicles, and 60% stocks. So keeping in mind the previous return assumptions, we're showing a weighted average return for Bob's situation of 5.3% for his RSP account. We use the same investment mix for his margin account, and for his TFSA account, we use more of a growth portfolio mix, so the weighted average return was 6.54% in this model. For real estate, we assume the residence was appreciating at 2% per year. Of course, Barb has RSP and TFSA capital as well. We're using the 20-20-60 for her RSP account at 5.3% weighted average return. And then we use the growth portfolio mix for her TFSA as well at 6.54%. For the cottage property, we're using an appreciation rate of 2% per year. Now, key to all these models, and it's one of the most important assumptions we use, is the burn rate or cash flow requirement. So in this particular model, we're using $100,000 per year in after-tax basic cash flow need for Bob and Barb. And then you can see in the column right here, additional needs of $20,000 per year for just discretionary expenses, principally travel. And those expenses at $20,000 per year indexed to inflation continue right through to their 75th year. So if we want to take a look at their expenditure levels over time, I'll show you the expenditure chart just in a minute. And in the initial models, Barb and Bob wanted to start their CPP benefits at retirement at age 60. And so that's what we've modeled for them. Now, in subsequent models that I'm going to show you, we altered that particular decision. But in the model I'll show you right now, they started CPP benefits at age 60. Bob is at 85% of the CPP maximum. And if we go to Barb, she's at 50% of the CPP maximum. So when you look at the model, you can see under government benefits, this is a roll-up for both of them. There's the Canada Pension Plan benefits they've accrued every year in the analysis that's showing up. And then old age security benefits, they're both at the maximum at age 65. Those benefits begin showing up in the model in the year 2030. One of the great things about SNAP projections is we have this cash flow model ordering column. And so we just click on the column, it gives us a drop-down box with the different cash flow drawdowns. So, which bucket are we taking from? And the dollar amounts get calculated based on the drawdown order. So we've got NTR, we've got NRT, TRN, and the list goes on. So if we use NTR, what's happening there is right from the get-go in all the models, registered account withdrawals have them right away. The RRIF minimum, of course, based on Bob and Barb's cash flow needs, we'll have to take out more from other buckets. So in NTR, the next bucket is non-registered. That gets used until it's fully used up. And the last account to be used is the tax-free savings account. One of the things that my team does is that as soon as we confirm the base case scenario, we'll begin modeling the different drawdown strategies. Now, we've been doing this long enough that we can pretty much estimate which drawdown strategy makes sense. But from a standpoint of just verifying, we can quickly do the drawdowns and see which one is the winner in at least the first base case analysis. Now, often we have to tweak once that's done, but it allows us to zero in on which scenario makes the most sense for the client situation. So let's leave this. I'm going to show you this summary chart that I put together so you can see how different drawdown strategies compare for Bob and Barb. So in this comparison slide, you can see right at the top goal progress. The best scenario is 97% goal achieved. The worst was 84%. So right away, Bob and Barb are not achieving their goals. So we definitely have to tweak and adjust things along the way. But it looks like the clear winner here is NTR, registered retirement income RRIF withdrawals right away to the RRIF minimums, topped up by non-registered, and then the final account, tax-free savings account withdrawals. The worst, not surprisingly, probably don't have to do an analysis to confirm this, is RTN. We're taking what we need to from the registered accounts to fund the income payments. And then the next account to be used would be tax-free savings accounts. Last would be non-registered. And that was at 84% goal achieved. The second best scenario, 93% goal achieved, was NRT. So again, what we're seeing here is that we're taking the RRIF minimums, topping up by non-registered until the non-registered is used out completely. Then we're taking the full amount that we need from the RRIF accounts. And then once the RRIF accounts are depleted, we're using the tax-free savings accounts last. So when we look at the different scenarios, none of them fully funds the plan, but you can see that the fund here, this base case scenario, we're running a shortfall in the long-term analysis of $224,000 of shortfall. Whereas the worst analysis, if we just kept spending out to life expectancy all the way through, is $1.1 million shortfall. So clearly we're going to pursue NTR. Let's go back and take a look at that particular strategy in more detail. So when we take a look at the strategy, I'm just going to do the roll-up where I've combined both Bob and Barb's drawdowns rates. And as a good first start in terms of drawdown numbers, you can see under the RRIF withdrawals here, they're taking out $38,700, $40,000, and $763, $42,925, and $45,000. So those are the drawdowns here. Now, in addition to those RRIF minimum payments coming from their portfolio, you can see over here that in the non-registered portfolio, we're drawing down $77,000, $76,000, $76,000, $75,000, so that by the 66th year, the non-registered portfolio has been fully depleted. Beginning in 2031 in this model, we're now beginning to see drawdowns from the tax-free savings account. So when you take a look at the drawdowns overall, what you can see here visually is that for the most part, they're pretty good. So there's the cash flows. We begin to see some shortfalls later on. That's what this dotted line shows us. And if you look at the money coming out of the portfolio, you can see that they've got their government pensions, CPP starting at age 60, their old age security benefits starting at age 65. There we have the RRIF payments over time. So RRIF minimums for the first number of years. And then we've got non-registered payments in the first several years of retirement. And then eventually the TFSAs, of course, help to fund cash flows as well. Here's their net worth statement, and you can see the financial assets going down over time so that theoretically by age 94, fully depleted. Now, some of you would look at this and go, hey, age 94, I'm not going to worry about anything. It doesn't matter to me if there's shortfalls. It matters to them. Longevity is in their family, so they don't quite like this one. They're encouraged that they have a basic starting point. But what we did from this particular strategy is we began tweaking it a little bit to see if we can push out that income for a longer period of time to not only cover off shortfalls, but actually have buffer dollars in the long-term planning. So we are at 97% goal achieved. Under goal progress, I've got 3 scenarios here for your review. The second scenario is goal achieved 104%. So now we're ahead of plan. And in fact, at age 95, this particular scenario has surplus capital of $301,000 in addition to real estate value for Bob and Barb. And then we have this scenario here, goal achieved 111%, and we have surplus capital to age 95 of $780,774. What were the differences in the 2 scenarios? If we take a look at this particular scenario, NTR CPP age 65, the only tweak we made to this scenario is we pushed back the start date for their Canada pension plan to age 65. That one change solved the issues, created a little bit of a buffer in the long-term plan. We then had the base scenario NTR, but we deferred government benefits CPP specifically to age 70. The other thing we did is we increased the equity exposure in the portfolio. We weren't super aggressive, and in talking to both of them, they were comfortable with adjusting the asset mix that we used from this original base case model. We made those 2 tweaks, and what that meant is they have 111% goal achieved, excess capital of $780,000 over the life of the analysis, so potentially more spending power and potentially more buffer room in their long-term plan. And in talking to them, I think they're okay with going ahead with strategies more akin to this 111% goal achieved strategy. Let's just take a look at the strategy very quickly in terms of the tweaks we made to the model. So again, when you look at the government benefits column for this model, we're pushing back Canada Pension Plan out to age 70 for both Bob and Barb. We're keeping the old age security benefits at age 65. And if we go across and take a look at the drawdowns of the assets, we're just going to look at the joint. You can see here, there's the RRIF payments. We then are going through the non-reg, and then we've got the TFSA withdrawals. Now, in addition to pushing back CPP benefits, we tweaked the investment portfolio. Bob's RRIF account's pretty sizable, and we had an investment return of 5.3 weighted average in the previous discussions. And so if you take a look at the portfolio, at 60% equities, we had a 5.3% return. We tweaked his RRIF account, and he was comfortable with this change. We moved it to a 70% equity exposure, 30% between cash and fixed income investments. That's a 5.61% weighted return. Again, not crazy aggressive. It's a 30 basis point difference between the two, so not a massive tweak. And then if we look at the TFSA accounts, we had a growth portfolio in the TFSAs through to about age 64, 65. And then we tweaked the investment mix to become more conservative once they started putting pressure on the TFSA accounts. So again, those tweaks were meaningful. So when you look at the long-term forecasting charts, we just take a look at the long-term trend. Again, no shortfalls at all in terms of the long-term numbers. You can see the cash flows are fully funded. Again, we've got the CPP starting later, old age security starting at 65. We've got the RRIF payments all the way through the analysis, TFSAs being used, and then non-registered fully depleted. Marginal tax rate pretty constant. There's the net worth position. So it holds its own. You can see that at the 95th year, we still have financial assets, fairly decent financial assets in the portfolio, in addition to the real estate value. So it creates some buffer for them. At the end of the day, they had a fully funded plan, and from a recommendation standpoint, they were overfunded by 11% from the goal. Okay, this is really important work because this is foundational to going to the next step, and that's the timeline or 3-bucket approach to setting up the cash flows for retirement. So this visual just summarizes what we've done together. We've gone through the deaccumulation plan, the interaction between RRIF accounts, non-registered TFSAs. This scenario did not have a corporation, but that is one of the things we get into often with folks that go through the retirement income planning process. Ultimately, we're trying to find that deaccumulation strategy that will maximize after-tax income. So we've done that part. The next part is we're going to allocate along timeline. So this is basically short-term, timeline 1, medium-term, timeline 2, timeline 3 is long-term. What's short-term, timeline 1? This is income and liquidity that's needed within the next 3 years from the portfolio. Timeline 2, 4 to 7 to 8 years, and then timeline 3, 8+ years in the portfolio. The longer you have in this timeline, the more flexibility you have with your portfolio strategy. So how do we fill up each of these buckets? Before we do that, we need to recognize that each of the timeline segments will have a different structure to the portfolio. We have the whole universe of investments to choose from, but when we choose them, we have to be very conscious of both the return and risk characteristics of the portfolio. Our options will be cash, real estate bonds, and then stocks between big cap, mid cap, small cap, and all sectors of the market. We want geographic diversification and we want currency diversification. Let's apply an all-market, broad-based portfolio strategy. That's our bias. Let's do what Warren Buffett says. Rather than trying to find the needle in the haystack, let's just own the haystack when it comes to portfolio construction. So again, when we look at the timeline, we've got those 3 timelines, timeline 1, 2, and 3. We've got $1.96 million in the portfolio. And when we look at the different nominal returns on this side of the chart, it's just giving you an example of what to expect. So these are not specific returns for this scenario, but we take a look at timeline 1, which will be returns 2.5% to 3% cash returns, 5.6% balanced portfolio, 7+% for a growth portfolio. Now, the idea here, as you use timeline 1 assets to fund income and liquidity, you're looking for opportunities to take profits or shift money from timeline 2 back to timeline 1 to refill that cash bucket. And then from time to time, in timeline 3, you're looking for opportunities to crystallize gains and profits and push those profits down to timeline 2, and then ultimately to timeline 1. You're cycling the portfolio on an ongoing basis to take advantage of growth opportunities that manifest themselves in the market. Now, there could be times when markets go down. And so in those periods, you're not touching timeline 2, but you'll be still using timeline 1 to fund income. And then eventually you can refill those buckets when you see recovery in the market. So timeline 1 for Bob and Barb is $389,548. That's the dollar allocation that you put in timeline 1. Where do we get that number from? Of course, we've got their expense needs. And to fund those expense needs, we have this bracketed items both for non-registered and for RRIF account payments. In addition to that, we'll share with Barb and Bob what the withholding tax should be to be remitted to CRA. We can set up these payments on a monthly basis, and we could do the same thing for the non-registered account. Now, non-registered, there's a little more work to go into the tax performance statement. What's the capital gains exposure? What about interest income and dividend income? And ultimately, we'll get them ready to be prepared to pay the tax due on the non-registered portfolio. Now, when it comes to the overall allocation, this is for Bob and Bob together, but then we have other financial statements, I'm not showing it on this particular video, that allocate the dollars by account in each of their names. Investment options, like I said, would be money market accounts, short-term T-bills, short-term government bonds, short-duration bond portfolios to top off this timeline. And this is, again, is a timeline where we're setting up those systematic payments to get that paycheck into your bank accounts on a regular basis. Timeline 2 is $565,430. Again, you can see the allocation from non-registered, allocation from their RRIF accounts, And then you're beginning to see some allocation from the TFSA account. Total allocation, like I said, $565,000. And we're looking at balanced investment mandates. Again, this presentation won't go into specific investment recommendations for that, but it's a balanced portfolio designed to drive returns in that 5, 6, maybe 7% compound return range. And then the last timeline is timeline 3. This money is not likely needed for a number of years, could be upwards of 8+ years, and this would be growth or equity investments. Could be equity or growth ETFs, mutual funds, managed accounts. Basically, you're focused on growth investments for the portfolio. Now, ultimately, it's going to be all synthesized in an overall asset mix and timeline mix. So for Barb and Bob, we've got timeline 1, that's 20% of their portfolio. Timeline 2 at 565, that's 29% of their portfolio. And timeline 3 is 51% of their portfolio. The allocation, they wanted to go with more of a cash GIC component to timeline 1, that's 389. On the timeline 2, it's more of a balanced position, about $226,000 in bonds, about $339,000 in stocks. And then, of course, timeline 3, 51% of the portfolio is 100% equities. At the end of the day, their mix is going to be 68% in equities, 12% in bonds, 20% in cash equivalents. So an asset mix of 32% between cash and bonds or rest in equities was an asset mix that they were very comfortable with. But that's not the case for everyone. Keep in mind how we arrived here. We started with the planning goals. We looked at their cash flow funding. We found the optimized drawdown strategy. That strategy then drove how much money is coming out of each of the accounts to fund the income, and that ultimately determined the asset mix. It's a very sort of concrete process. But when we get here, maybe there needs to be a fine-tuning of the asset mix based on the client's investment temperament. Maybe, Shaun, I don't want as much as 68% equities in the portfolio. I'd like to push more money in this direction. That's fine. We'll redo the weighted return calculations. It may have a ripple effect on the outcome of your plan, and that's part of the iterative process. It's a good exercise to go through. So at this point, if you're saying to yourself, I'm not exactly sure that I've optimized my drawdown strategy. In fact, I'm not even sure if my portfolio has a 3-bucket or timeline approach, and it sounds like a reasonable idea. And further to that, I'm not exactly sure of the investment mix that's appropriate for my situation. If you have those questions, just make sure you go to the show notes. There's a link back to our homepage. There you can book a complimentary call to find out more about our retirement planning services and get your own customized drawdown strategy.